The inflation rider is really critical because what may cost $200 a day now, by the time 20 years goes by, could easily be double that. Could be more than double. We don't really know. The cost of nursing care has exceeded the rate of inflation by quite a lot. It's averaged about 5.5% to 6% over the last 15 to 20 years. So the policies have a 5% compound inflation rider, and that's very common across companies. But it's not quite enough to keep up with the pace of healthcare inflation. So I think that's a critical part. When I purchased my own policy, and I keep forgetting to go back and see what year it was, I believe it was about 1990, I bought an $80 a day plan because that's what the cost of care was then. With the inflation rider in place, it's up to about $190 a day now. So it isn't quite keeping pace, but it's close enough that I'm very comfortable with it. And I have the home care with my plan, so I'm comfortable knowing that I can receive that care at home, I can receive it in an adult daycare center, I can receive the care in assisted living or in a nursing facility. So you can really receive the care almost anywhere. It's just the activities of daily living and the cognitive impairment that are your triggers. However, as I mentioned, the little to's and froms language is very important. So when we think about how our care is going to be given 20 years from now, it's kind of tough to figure it out. But I've attended enough aging conferences to kind of get a glimpse to the future. The technology is one thing, but the other exciting thing I see is sort of a coming together again. Our families have dispersed because they've had to because of jobs, so our children are living at a distance, and we're getting better and better at creating our own chosen family. And there are pod housing, planned housing, different communities that are being built, small-scale homes facing one another or in a semicircle facing one another with a community building, sometimes in the middle, sometimes at the end. But it's all about encouraging, caring for one another, and coming together to socialize and to have meals and to even have a living space for a caregiver. And that is pretty exciting to me because it means that we're going to be part of a community, or can be part of a community that will help care for one another. And then when we're not able to, then a caregiver will be on duty to help with that. So how does the policy language match up with that? And that's what I look at. If the caregiver is with a licensed, state-licensed healthcare agency, that's what most of the policy language is going to require, that it be a state-licensed nurse, aide, whoever. And as long as you're hiring them through that state agency, then they're going to be approved for the policy. So those are the kind of things to look for when you're looking at long-term care. In Indiana, we have the advantage of being one of the original 4 partnership states. When Governor Bayh was in office, he, being a baby boomer, I think, saw the handwriting on the wall as to the cost of health care and where it was going. And so he gave the approval for Indiana to be part of this partnership. And it's simply an agreement between the state of Indiana's Medicaid program and private insurance companies to give us incentive to purchase long-term care insurance. The way it works is we now can protect all of our assets against Medicaid spend down as long as the policy we purchase has the Indiana seal on it and the pool of money in the policy meets the state criteria for that year. For 2009, the state criteria is $239,447. So when you buy your policy, you take the daily benefit times the number of days in the year times the length of the benefit, say 4 years, and if it equals that $239,000 figure, then you're going to have a total asset protection plan. It's worked pretty well. It's given many people enough incentive to go ahead and self-insure. And it doesn't matter if you have $200,000 or $5 million. If you use up that policy, your assets will never be taken with Medicaid spend down. Your income is required to be used towards your bill, but beyond that, the state would make up any difference in the bill. So that's a good incentive. Other states have finally started to follow suit. There is much discussion about the states having a reciprocal agreement. Right now, Connecticut and Indiana will honor each other's policies on the